Hi, Chris. Thank you very much for joining us today. I recently saw an interview that you gave, and I was really intrigued by your comments where you said the market's going to rally up until May or June timeframe, and then you expect a serious correction in the stock market. I believe you said as much as 50%. So I want to start right here and tell us what you think about the stock market, more specifically the S&P and the NASDAQ. What are your views?
Sure. Yeah. Well, there's a lot of layers to that to come to that conclusion. Well, thanks for having me on the show. Always a pleasure. Anyways, if we jump onto the charts, I can show you my view of the major indexes here of what I'm looking at when it comes to the SP 500 and the NASDAQ. Now, I used to like to start off with just talking about the four stages of the market. So Stan Weinstein wrote a book talking about the four stages. And if people understand, so I'm a technical trader. I follow price action. That's how investors make money. We want price or the asset to move in the direction we're positioned for. So I don't factor in any news or any economic data or the Fed. Nothing really comes into play here. So if you look at the markets from a price standpoint, there's four stages. Everybody loves a stage two, which is a bull market. That's an advancing stage. And we can make a ton of money in a stage four decline, which is a bear market. Both of those trends are green because they're strong trends and we can profit from those. Now, the difficult times in the market are stage three topping phases, which is what we're in right now, and a stage one base. So if we were to just focus on the stage three topping pattern right here, you'll notice you'll have stocks have this massive run up and eventually they have a sharp crack to the downside. And then they go into this sideways phase, this complacency move. And typically what happens during this phase is a lot of the average investor starts to think that, the bear market has taken place, which would be equivalent to 2022. We saw that 24% correction in the market. And people think the bear market is over. But really, we're just in this complacency mode. And if we were to look at the emotions of the investor, they think the market's cooling off. And right now, we're seeing the SP 500, the NASDAQ, as you mentioned, James, hitting new all-time highs. And it's sucking everybody into the market who thinks we're really starting a new massive bull market that could last many years. And so it's this pattern, this crack to the downside, and this consolidation is a big warning sign. But we are seeing the indexes hit new highs, which confuses people. And the best way to show you this is if we were to just look at the longer term picture, we'll go to the weekly chart of the SP 500. As we can see here, the SP 500 is hitting new highs, but that is driven by a handful of big tech companies. If we look at the NASDAQ, it's the same thing. We're just driving up. We got the AI push, the NVIDIA push, the semiconductor space, doing all the heavy lifting. Now, if we were to look at just the SP 500 with equal weighting, so all stocks are worth this, have the same value or weighting in the portfolio, you can see we are coming up to a major double top. We had the big correction in 2022. We're now in this complacency stage and we're set up for a double top, and we might even pierce to a nominal new high on this equal weighted basket or index weighting. Just like we did in 2008, we saw a similar price come up on the SP 500, poked to a new high, and then sold off 54%. So this gives us a good idea of what the majority of stocks are doing if you get rid of the big tech heavyweights. The other part of this market that really makes this interesting is the Russell 2000, which really is the majority of the stocks. This is thousands of stocks, and you can see they've had the big crack to the downside. Now they're in this sideways complacency move. They've had a nice run recently, but they are nowhere near their highs. And so if you look at the equal weighted SP 500 and the Russell 2000 blended together, you can see in general, we have this stage three topping phase. And this is what the market does best. It gets headline news with the NASDAQ, the SP 500, both hitting all-time highs. NVIDIA has got this feeding frenzy in technology and semiconductors. People I know who have never been in the stock market right now are downloading apps and they're buying NVIDIA on their phones, and they don't know anything about the markets. I remember when this was happening during Bitcoin, right when it topped many, many years ago. So this is like the feeding frenzy of the market, sucking people in. before we go off this cliff, and this is the mental state that people are going to go through. We're going to start to break down, I think, late this year. People are going to go into anxiety, and eventually they go through this whole emotional roller coaster. They're going to be in denial how much they've lost, and then they're going to be in a panic stage because they can't sell out. But eventually they'll hit this euphoric phase where they can't take it anymore. So this is kind of the way we're going to be going, and very painful for investors. And that's where I see the broad markets in general, kind of from that big picture view.
And what if you do the same thing with the NASDAQ? How does it look?
Yeah, so I don't have equal weighted for the NASDAQ, but I mean, it's tech heavy. It's definitely more like a tech sector. So I always look at the SP 500. To me, the SP 500 is more so the broad market. If I can identify the trend of the SP 500, I know where I want to put my money, whether it's in stocks or bonds or a currency or a commodity. To me, the SP 500 is the tide, and then everything else around it is going to move more or less than the SP 500, but generally follow the trend of the SP 500. So again, the NASDAQ, I think, is very heavy weighted in technology. We're seeing money rotate into biotechs, the ARK ETFs. In fact, if we take a quick look at the ARK K ETF, which everybody got involved in before, you can see a stage one, it had the stage two blow off top, complacency move, and we've gone down, and now it's forming another big potential pause. I actually see the ARK ETF going down to around $16, $18, maybe late this year or next year if we do go into another recession. But this is when small caps and growth stocks topped out. This was March of 2021, and small caps have been in a stage three, and they've already gone through a major bear market phase, and they still are in a bear market. So depending on the group of stocks you're watching, they may have topped out, a couple of years ago already, and they're actually just having a big pause before they're going to go a whole lot lower down the road. But when we look at the major indexes that everybody follows, the SP 500 and NASDAQ, they are still obviously in a very strong uptrend. You do not want to fight it. We are long the markets here. But when it does reverse, there is going to be, I think, a lot of downside and, 40, 50% correction in the markets. It could get pretty bleak, which is an opportunity. If you see it coming, you know how to navigate and sidestep it or profit from the chaos. So that's the whole understanding of knowing these four cycles, these four stages of the markets. They all require a different strategy, unless your strategy can evolve with them. But that is the key to navigating the stock market and not having to hold through massive drawdowns and take big losses.
And I believe one of the issues with ARK is the fact that she does not have any exposure to NVIDIA or AI in general. So she's not participating in this move.
Right. Yeah. Yeah. But there's also a big difference with ETFs, right? So like ETFs, they have a set criteria. They have to buy a certain weighting of all these different types of stocks, and then they have to hold them. So, you get into an ETF, even though she might have seen the markets going for a correction and being like, oh boy, these ETFs are going to get hit hard. Those ETFs have to hold those positions and just take the hit. So just because somebody who either you love Cathie Wood or you hate her, it's like Elon Musk, they're extremes. It's love or hate relationship. Even though some of these people are amazing who put these funds on, problem is their hands are tied. Once those funds are in place, they have to go with the ebbs and flow of the stock market. And a lot of people, I think, invest in her and buy her ETFs, not realizing that, she can't really just change the strategy, because there's a trend, a major shift in the markets. She has to just let that ETF fall with the stocks. So that's where a lot of people, I think, actually get a big disconnect. They invest in the investor and don't realize the ETF isn't going to do what they might actually be doing with their own money.
Now, you mentioned that you expect a 40 to 50% pullback in the broader indices, like I'm assuming you're referring to the S&P and the NASDAQ?
Yeah.
Okay, so maybe you can just articulate exactly how you get 40 to 50%, because that's sizable.
It is. I mean, it's difficult to gauge. Let's just go back here. This is the 2008 bottom. We've got the COVID bottom. I mean, I'm a big fan of Fibonacci retracements, Fibonacci extensions. We can draw a few different significant lows Typically, the market likes to pull back roughly anywhere from 38 to 61% based on these moves. And there's some different standout lows that we could go back to. There's another one here. I'm just going to overlap a few of these. Get a little messy, but let's go back to another one here. And another one back over here. So long story short, if we were to take a look at this chart and just look at these different levels. So the pink lines are usually going to be the first wave to the downside, the first breakdown. The purple lines, which are woven in here, are the halfway point of the market. And then the greens are the levels where usually we see a big washout. We see a lot of panic in the market. So if we were to just look at these levels, these pink levels here range from about a 20 to 30% pullback. The 50% level, which is very, very common. This is the most common level I find where those levels are. We're anywhere from 27 to 40%. And then we could see this come all the way back down to around the 618, which brings us back down to those COVID lows. And that's about a 50% correction. So based on 1, 2, 3, 4 very significant lows, all of them tally up to pull us right back to the COVID lows. And it's about 50%. And that's just based on Fibonacci momentum from the start of a bull market to the end of the bull market and then retracing. And there's been, obviously, these standout lows are very significant turning points in the economy. Each of these were difficult times in the market. There was some type of shift or change. And so that's why I'm using those. And the nice thing is they all cluster in these areas to give us these downward targets. And typically the market, I mean, once it starts into this feeding frenzy, this sell-off mode, it goes into a collapse phase where it's just a waterfall sell-off. And if we just zoom out a little bit more on this chart, let's go back. I actually believe we're very similar to a 2000 type of scenario. In fact, you and I were talking about this actually before we were on camera, how it feels just like, the late 90s, 2000. Yesterday I had this crazy feeling. It was almost like a flashback, a deja vu of like, wow, I had this exact feeling back when I was trading technology stocks when I first started trading. And I had that yesterday. But when we look at the US dollar index, when we look at the fact it's trading, it's on a huge uptrend. I think we could see the dollar really take off as the stock market sells off, just like after the tech bubble. We're in a tech bubble right now. The dollar is trending up just like it did, during the 2000 tech bubble top. So all these things are unfolding, and it's going to become the perfect storm, I think, for precious metals. Uranium stocks are probably going to go ballistic as well. But all these are big chart patterns, and I think this isn't going to be a very fast drop. I think it could take a couple of years, just like the tech bubble. It was a multi-year bear market before it bottomed. And then it took the NASDAQ 16 years to recover. I mean, if you don't sidestep it, you might not see any growth for 16 years, which is very painful if you are looking to generate, annual income, or, you're retired, all those things that you definitely don't want to go that long without income. So it's best to be protected. And that's how I come up with that 50% kind of max pullback from here.
Okay, so a pullback of 50%, but then that would evolve over the course of 2 years, correct?
I would think so. I mean, it could be a year, it could be 2 years.
And why did you pick May as the point when the market's going to top and then begin to sell off?
Right. So if we take a look at seasonality wise, we tend to have a good run through January to May. May through July is usually where the market starts to top out. And then we go into a sell-off. In fact, this seasonality chart is identical to last year's price action. You pull up the 1 year of last year, this is exactly what we saw. And I think we're going to see this feeding frenzy. I think right now, the last of the people who aren't in the markets are getting in right now. They have FOMO because they missed out on last year's move and they're not in yet. It's also sucking in those who have never even been involved in the markets. They're finally saying, you know what, I'm going to open an app and buy $500 of NVIDIA. So I think there's still some time to suck in the rest of those people. And I think we're going to
I haven't bought an NVIDIA yet. Okay. So we're not at the top yet.
Right. I haven't either.
That might be coming.
So anyways, I think we have a few more months of this momentum of the hype, the tech pulling people in before it kind of runs out of steam.
So why
And
don't we take a look at NVIDIA because it's so significant now. We recently saw the numbers or the CPI numbers, and the market got hit on the back of that because the numbers were stronger than we were expecting. But then a short time later, NVIDIA comes up with these blowout numbers, and the market just takes off again. And so here we are. Look at this thing.
yeah, this is the weekly chart. And I was talking on another station about a month or so ago. We were talking about this big pattern. So I'm a technical analyst, and following the price, we have a rally up, and then we've got a bull flag pattern, which is known as the halfway point or a consolidation point. And then you see the second half of that move go higher. And what was really interesting was we took the lows here, we took the highs from this pattern, and then we took these lows and we carried it forward. And it points to right where we are right now. And I think I was talking to Craig Hemke. Him and I were talking about, I said 784. And I said this like weeks and weeks ago is the next upside target. And typically the way Fibonacci extensions work, I use the 618 and the 100%. And if you hit the 618 and there is a pause or a pullback, that means the momentum and the measurements are accurate. And you can see we ran up here on the daily chart, we paused and pulled back for a few days, and then it took off, and now we've hit that 100% measured move. So based on this huge pattern, NVIDIA has just hit its top. So now to me, we are in like the blow off phase. This is like, you never know how high it's going to go. The momentum here is now kind of, it's in no man's land. If people just keep chasing it, they could send this thing up to $1,000. But it's in bubble phase. So to me, it's in bubble phase anyway. I'm not a big tech crave. I don't buy individual stocks. I only trade ETFs. But we are definitely in nosebleed territory. The general public are getting sucked into NVIDIA. And to me, that's usually a red flag saying, hey, look out.
Yeah, and I just want to reinforce the strength of this move and the size of this move. This year alone, NVIDIA is already up 60% of the year. We're only 2 months into the year. It's gone from 500 up to about 800. And it's just, now it's the third largest company in the world. Market cap's around $2 trillion. And this is truly unbelievable. But I want to go back to what you were saying earlier, how it's very reminiscent of the late 1990s, early 2000s, because we saw these types of moves back then, right?
Mhm.
And a lot of people got wiped out because they were trying to short it. And I'm sure a lot of people were trying to short this thing back in September, October, November, and they got their faces ripped off. And here we are now at new all-time highs.
Yeah.
But to your point, do you see this thing migrating toward $1,000 or higher?
It's in a strong uptrend. Yeah, I mean, it's right now is just a bulldozer just driving its way up. It's you do not want to jump in front of it. In fact, I had a subscriber about a week and a half ago who was loading up on 3x inverse ETFs, and he ended up blowing his account up and doing a lot of damage. And it makes no sense. There's no point in trying to pick a top or bottom, because if you try and pick a top and you get run over, you blow your account up. The problem with shorting something or betting against it to the upside is that it can keep going up and up and up. It's endless. That you have unlimited risk. Buying a bottom, trying to pick a bottom is a little bit safer, because if you hold on long enough, it might recover in 5-10 years and come back from the dead maybe, or get bought out or something. But yeah, I mean, there's huge momentum behind this. I'm not a fan of the big gap up. I'm not a fan of the move based on news. I find anything based around news, and usually that move gets given back. So it's definitely in really volatile state. And, it's a crapshoot whether it pops up to 1,000 or if it drops back down to 600.
So this is definitely a risk on trade. And I think the other trade we should take a look at is Bitcoin, because that also falls into the same realm. But what are your views on Bitcoin?
Yeah, I mean, Bitcoin is in a very strong uptrend. It's been trading this rounding formation here, building a base, a stage 1 base, and it finally has broken out of that base. And so now it's running up, and it's in a strong uptrend. When we look at the bigger picture here, you can see it is getting up into this previous peak. I'll just stretch this out a little bit more. We are getting up into some of these previous peaks here where there's going to be resistance. There's a lot of chatter. So it's stuck at a little bit of a resistance point, but if it can break through here, then we're probably going to see the 60,000. It will be the next level. There's some hiccups here on the chart, a pullback, a break up and a breakdown, and a bunch of other highs and lows through here. So 60,000, if it can break from here, will be the next upside target. So, I mean, I'm bullish on it. It's definitely in an uptrend. It feels like it needs a little bit more of a pause or a breather. But this is the thing, the groups of people, a lot of people who trade Bitcoin, and when they get into like, you know, NVIDIA feeding frenzy, is sometimes you don't get a nice pause and and then a rally, and you just see it like pull back for a few days and then take off again. And the problem with that is something that goes straight up typically comes straight back down. So if something just goes absolutely insane to the upside, you usually see like half of it get wiped out. And you see that over and over again. These straight up moves usually are, you know, resulted in a straight down move. So I'm not a huge fan of, you know, a really strong big move up here. But you know, in a nutshell, it's in a very strong uptrend. It had a big base. It built a launch pad. It's launched. And now the question is, does it consolidate and take a while to go higher? Or is it, you know, going to just continue to go up here? But right now it is stuck under a short-term resistance area.
Right. So just to summarize, do you see it taking out its all-time highs of $70,000 here in the next short while, like before
I'm
May?
not sure. I mean, I don't follow Bitcoin that much. It's not one of those assets that I really get the full correlation. Sometimes it moves against the stock market. Sometimes it moves with the stock market. To me, it's very difficult. Actually, it's very similar to the precious metals space, where gold miners will rally with the stock market sometimes and do really well. Other times they do the exact opposite, and you never know when that disconnect happens. So trading the markets in general is difficult. And then you throw in something like Bitcoin or precious metal miners, then you add in a whole new complexity, because sometimes it just disconnects and does the opposite of what it should be doing or has been doing. And that's why a lot of people suffer from, I think, trying to trade Bitcoin and miners, is they get stuck because they just disconnect and they go the opposite direction that they should be, more or less. So, yeah.
So you mentioned gold. Why don't we take a look at that? That's like the inverse of Bitcoin in terms of performance. Bitcoin was up 160% in 2023. I think gold was up maybe 10%.
Yeah, like when we look at gold here, it has a very strong chart from a short-term standpoint. It has a very strong rally here. It's got a pennant formation, which is known as a consolidation pattern. And whatever the trend is going into a consolidation is usually the trend that's going to exit that consolidation. So it is pointing to higher pricing. Gold is holding right up near all-time highs. It is a, pardon the pun, a solid asset. It moves very slowly percentage-wise, which means people can put more money there and feel comfortable. The people who buy gold tend to buy gold and never sell it. And that's one of the reasons why gold holds its value and is holding its value really well compared to its little sister or brother silver, which is down, you know, 50+% from the highs. When we look at the big picture of gold, you know, we are, I believe, in a very similar period as what's going to happen after the 2000 tech bubble. I think we're going to go into, I think we've already started the super cycle. I actually think we already started it back in 2019. And any pause that we're having here in gold, and potentially we see it run up a little bit more, but then we're going to have this, I think, stock market correction, and gold is going to struggle. And then eventually gold and silver and miners will take off for a huge run, which will probably be like 2,700, 3,500. And the bear market scenario that I think we're going to go through for gold will be very similar to the last stage 4 decline that we had over here, the 2008. We saw gold pull back 34%. It was the first really asset to turn around and find a bottom, well, months before the stock market. And then it went off to this massive rally. So I believe we've already started this rally, and we're kind of at this big consolidation halfway point. And then eventually late this year or next year, if the market cleanses, the overall financial system cleanses, real estate and stocks and everything, currencies, everything will go for a real wild movement. then I think we'll see precious metals really take off. It'll probably be the last opportunity to pick up gold, silver, and miners, I think, at some incredible pricing, because then they take off hundreds and thousands of percent. So I'm really excited about it, but I still think there's a lot of damage that needs to be done to pretty much all asset classes, other than the dollar. The dollar is the flip. If we actually take a look at the dollar index, as I was mentioning earlier, in 2000, the tech bubble, we saw the dollar continue to move up as the stock market sold off. And the dollar usually gets very strong during a bear market. In 2008, we saw the US dollar post a huge, strong gain during that bear market. And I believe we are going to see the stock market go into another recession. The dollar is going to come up to the highs we saw a couple of years ago, or maybe even muscle up to the highs from the 2000 tech bubble. And then once all that's said and done and the markets have cleansed, we're going to probably see the dollar go out of favor for a decade, which means commodities and other assets are going to rally substantially for probably a decade. So these are huge cycles we're talking about. These don't happen just next month. These will take the rest of this year, maybe even beginning of next year to kind of unfold. But these are life-changing turning points in the markets. These can allow you to retire super early if you catch them properly. I mean, this is the type of stuff, we're all in the markets for, is to identify and catch some of these mega year trends, have our money positioned, versus like the buy and hold strategy, which you ride these things out. You have a good year, you're at all-time highs maybe now, and then you're down 30, 40% or more a year from now, and you're panicking and your whole life looks different now because you've lost half your wealth. So, active investing is very powerful if you understand the movements, the technical analysis of what the charts are saying, and make sure you're always trading with the long-term trend and the short-term trend. That puts everything in your favor, and actively, managing positions.
Well, I hope you're right about gold. It'll bring some life back to my portfolio.
Yeah.
So why don't we take a look at silver?
Sure. Yep.
I just had a conversation with Rick Rule recently. He's very bullish on silver, not so much in the short term, but going out further into 2025, 2026.
Yeah, I mean, I think silver is going to do very, very well also. We're equivalent to this. I didn't show it in gold, but gold has a very similar setup here. So we saw silver market consolidate for a while, for a couple of years. And then just as the stock market pushed up in 2006, 2007 to put in its top, we actually saw silver, gold, and miners rally very strong. And then when the bear market hit, we saw silver and everything pull back. Gold did the same thing. And I believe we're in a very similar scenario where we've kind of got this big consolidation. We might actually see gold, silver, and miners actually start to have a nice, decent little run. Maybe silver comes back up to this $30 level going into May. And then when the stock market potentially tops in May, then we're going to see things correct and take a bit of a beating for a little while. But this beating that comes is actually the best opportunity for anyone who's interested in precious metals, because you buy here and hopefully we're going to see one of these rocket ship moves afterwards for almost instant gratification. This is long-term charts, but within a year or two could have some pretty substantial returns. And silver always plays catch up with gold and then surpasses it percentage wise. But it is a much wilder ride. So, if you can
Do you think we're going to see this move before we pass away?
I hope so. I mean,
I've been a long time coming.
Metals forever, and everybody talks about the big short squeeze and how it's all manipulated and gold's manipulated and it gets hit down at certain times every day. And all I can say, because I hear it all the time, and people get angry and they say it's why they're losing money and they're not making money. And the reality is anything in this world that has money involved in it is rigged and manipulated in some way. The precious metals market, the stock market, everything is, you have to just realize there's nothing you can do about it. I don't believe. You have to learn to work with it and understand it's part of the game. And it's, for all we know, I mean, 20 years ago, people were talking about there's going to be this massive, huge short move. And I guess you could say maybe it's happened. It went from $4 to $48, but it's not what everybody's expecting, is this big unwinding of crazy amount of contracts having to get delivery that is impossible. But yeah.
People are always looking to justify their mistakes, right? And of
Yeah.
course, the longer they maintain those mistakes, the more they try to stick to a certain narrative, and that's all it is. I agree with you 100%. There's always some form of manipulation going on in whatever market, but for the most part, the vast majority of trading that's going on in any financial markets, especially in North America, it's on the up and up. And the markets are so big now, and so it's impossible for anybody to control them and manipulate them the way a lot of people think is being
Yeah.
done in the silver market.
Yeah.
So why don't we, okay, so we looked at gold, we looked at the USD, we looked at silver. Why don't we take a look at WTI?
WTI. Let's take a look here. All right. So the chart of oil, once it loads, got a little zoomed out too far. This might take a bit. Hold on. There we go. So my view, I don't have a whole lot of insight on oil other than I think it's just kind of hanging on at this point. It's really kind of in the middle of the range. If we look at kind of these highs, these extreme lows, it really is just kind of trading in the middle of the range. So oil to me is just nothing that exciting. I think it's trying to figure out if it is going to break down. I do think potentially later this year, next year, whenever this market correction takes place, I think we're going to see back down to $40 oil very easily. The fact that we can go negative makes 40 seem like it's a fair value. But you know, a lot of people are like $40, it can't go down to $40. I think people got so used to like this, for some reason, people only remember the high prices that they want when they all piled into energy stocks. But $40 oil, you know, it has been hit many, many times over the last, 10, 15 years. It's not like it is an extreme low, but I mean, it's a fair value and oversold value that this market just tends to naturally want to sell off. So I am more so bearish on energies. I think we go into this recession, we're going to see shipping cut back. We're going to see spending and travel and business travel, you name it. And of course, it's going to hurt the oil space. So I do think it'll sell off. Right now, it's kind of in no man's land, just chopping around sideways. I would give it a bit of a bearish bias simply because it has sold down in price here. And it really is just kind of consolidating in this channel. It's just kind of ping ponging around in here. And it is pointing to lower pricing down the road.
And you touched on uranium earlier. We should take a look at that. It had a massive 2023. I believe it was up 80% on the year.
Now, when you say uranium, do you mean like uranium stocks sector or?
Well, the Sprott Physical Uranium Trust or Spot Uranium, the physical.
Okay, yeah, I don't have that pulled up here. I'm not sure what that is, but I got a good feel of it through the URA, which is the uranium kind of ETF, which I get. What symbol does Sprott have for that?
It should be just letter U in Toronto. Try U./U maybe.
Let me just take a look. I just have to change the symbol.
Or if you just punch in Sprott Physical Uranium.
Yeah, this platform struggles to pull it up. I can't just type in the name.
No.
I'm not sure. I have URA, which we'll use, I guess, for now. I can't pull up the Canadian symbol, but I mean, you look at the uranium space. I was actually on a uranium podcast. I think it was early last year, and I mean, the story for uranium is incredible. And I was talking to somebody last year about this, and really, the move towards climate change and trying to have like zero carbon. The only way to really do it is through energy created through uranium, like nuclear plants. And there's these small little plants now that are not that large. They're size of like a house and they can power like an entire state. So I think uranium is going to come back as from the dead of nobody ever wanting it to suddenly it's the cleanest energy that we could use. And the density, the power density of it is massive. And, it's probably going to come back as one of the strongest things, which is why we're seeing uranium stocks come to life. And, there's all kinds of them starting to pop up, whether they're real or not. I don't know. I remember I was a lot in the precious miner space. a lot of miners, you know, eventually they turned into marijuana stocks. I'm like, when did it switch over to a marijuana stock? And so I think we're seeing the same thing. I think there's a lot of people seeing the opportunity in uranium. So all these little places are, I mean, I think there's hundreds of uranium companies now popping up, whether they're real or not, I don't know. But I think there's a very bullish story. I do think uranium could pull back and pause for a little while. I think it's probably had a good chunk in terms of the stock pricing. We've really seen stocks kind of put in a bit of a double top here. It's starting
And
to look a little tired. So a
so the
pullback.
second largest producer in the world is Cameco, CCJ in the US. Can you pull that up?
Sure. All right. Let's just get a big picture view here. So yeah, even the large cap, the biggest one, I mean, it is coming up near double top territory, same as 2006. So it's definitely had a massive run. It'd be interesting to use Fibonacci extension here and just see where this goes. So we go from the low to this high and down to this low here, carry that forward. So more or less, it is pretty much at that 100% measured move, having, it looks like big volatility. If we zoom in, that looks like, yeah, big gaps to the upside, a gap up, a huge sell off, a huge gap up, a big sell off. This is like a little double top. All this stuff here is telling us like, it looks like an exhaustion. It's hit the 100% move. It's hit resistance from 2006, this blue line, and it's getting rejected. So I feel like the wind is, you know, we traded URA. We were long uranium stocks a little bit last month or a month or two ago. But they look like they've run out of steam for a bit. And again, if we go into a stock market pullback, a big one, these are going to get hit and they're going to be that prime opportunity to pick them up. I think really cheaply. They'll probably have a huge percentage drop just because they're small caps in general and really volatile.
So
So
what's your target on Cameco? Where do you see it pulling back to?
let's just grab a Fibonacci retracement. So we could go a couple different levels. We can go from this foundation to the top here. And I am just going to get rid of one of these lines so that it's easier to see. All right, sorry, I got rid of the wrong line. Okay, so if we go from this halfway consolidation to this rally up, it's showing that we're looking around $36, potentially down to 32. If we go from the low that was down here and pull that up, it's showing us more or less around 30, 33, down to 28, maybe even down to 23. So there's still a pretty big pullback potential in the price, which is anywhere from about 20% or so, all the way down to about 40% pullback. So there's still quite a bit of volatility there for sure.
And why don't we take a look at Newmont?
Oh man, gold miners, they're just not getting any love.
That is one ugly chart. Like, can you imagine if you held this thing for the last 10 or 20 years?
Oh, let's just take a look back. Yeah. I mean, yeah, I mean, I'm not a fan of a chart that does that. It's really done nothing. I mean, it does pay dividends, which is nice, but it hasn't really done much unless you know, especially if you bought it somewhere way up in this phase. Yeah, gold miners, they're just not finding the love. There's no excitement. You know, if we take a look at, for example, just GDX, which is a good barometer of stocks in general for this space, and we zoom into the most recent time frame over the past 2.5 years, I mean, it's just choppy. It's all over the place. I've talked about this in pretty great detail where the stock market will, you know, give us a signal when we want to own stocks, and gold miners will go the exact opposite direction. And then the stock market will say, get out of the stock market, it's heading down. And then gold miners will rally. And then we get another signal and gold miners do the flip. They do the complete opposite, and they make it very difficult. And I don't think a lot of people realize the extra layers of risk and the difficulty in trading miners. I mean, unless you're just going to buy it and hold it forever, which, you know, is a strategy. It is very difficult to trade these because you get into this type of noise. I mean, Newmont hasn't gone anywhere in forever, really. It's gone up and down, but it's still in the lower end of its range. So it's difficult. I think when the time comes, when we enter that new perfect storm, that kind of um, what I call is like the next super cycle to the upside in the commodity space, I think gold miners are going to be phenomenal play. And I tend to want to lean towards the tiny micro caps because that's where I had some amazing experiences many years ago because they can move hundreds, and thousands of percent. So that's where I want to focus when that market condition lines up. I won't be that interested actually in the ETFs or the big companies. I want to get into little stuff that are going to be like lotto tickets, more or less, high probability lotto tickets.
And why don't we take a look at one more stock, Exxon, just to see what's happening there.
What's the symbol for that again? X.
XOM.
Right. Yeah, so we are seeing when we look at it from the shorter standpoint, it is starting to kind of break down a little bit. So we've got this upper range through here where it kind of broke up here and chopped around in this range. And now it's kind of started to move lower and it's kind of stuck under resistance. It's similar to crude oil. It's kind of stuck at a short-term resistance right now. We'll see if it can get some traction and get above here. Maybe it's going to have another push higher. But overall, it's not the best looking chart. I'm not a fan of a big consolidation. And then it is making a series of lower highs, more or less, and lower lows. So not a whole lot of excitement there. It looks kind of like dead money at this point. And we got to wait to see if it's going to get back up into this range.
And you mentioned earlier that you're negative on oil. You see it going down to $40, I believe you said. So
oh yeah, it'll hurt the energy sector in a pretty big way. We'll see. We'll probably see a big pullback, probably somewhere down in this, 70, 80 range, I would think for Exxon. But it really depends on the type of selling, the reasons for the selling. Some sectors move a lot more than others, or go into a precipitous waterfall. You have one bank go bankrupt overnight, and the regional banks fall like 20, 30%. It's crazy. So there's going to be some sectors that are just going to just fall out of bed and be dead, and other ones will hold their value. We just have to see what the reason is for the next major financial reset. Every time there's a tech bubble, or there's a financial crisis with housing, there's always something different. It'll be interesting to see what 2020 after what it was that caused it and why, and we just really never fully know until it's done.
Chris, most of our discussion so far has been based on the US, but I want to talk about Canada and seeing how we both reside here. And do you have any concerns about the Canadian housing market?
Yeah, I think Canada is going to struggle really badly when it comes to the housing market. A perfect example was last November, I had some servicing done to my truck. The guy who was driving me home ended up saying, "Hey, do you need to buy a property?" I'm like, "No." And I said, "Why?" He goes, "Well, my mortgage comes up for renewal in April, which is like a month and a half from now." He says, "My rate triples from what I have." He goes, "I can't afford the mortgage. I know I'm not going to get approved for the mortgage." He's like, "I have to sell." And they're actually moving way up northern Ontario where homes are way cheaper. And anyways, this is the big problem in Canada. Most of us have a 3 or 5 year fixed mortgage. That's the majority. COVID was 3 years ago. So this, starting like April, we're about to start rolling into a storm of people getting their first mortgage payment or having to renew and going, "Oh my gosh, I can't afford this house at triple the price." So this is going to be a big problem. And I think we're going to see this take 2 to 3 years to unfold because the majority of people have a 5-year mortgage, which is another 2 years from now. So we're going to start seeing bleeding this year. And then next year, people will have heard about it who have a 5-year, and they'll start worrying already before they're up for renewal. So I think about a year and a half from now is going to be an opportunity for those who want to get into real estate, because there's going to become a bidding war of everybody's going to try and sell their home, and they're going to be undercutting each other because they want to just get out of it. And it's going to be huge, huge opportunity, but a lot of people are going to suffer, unfortunately, just because of the huge jump in interest rates.
Well, those are interesting comments, and that gives me a great idea for a future interview. I'm going to have to get somebody on that knows the Canadian real estate market intimately, because I think that would be a great topic. So why don't we just summarize everything we talked about here? And so once again, when it comes to the US economy, we're more specifically the US financial markets, the S&P and the NASDAQ. You're very bullish in the short term. You think we're going to continue to move higher going into May or June. And then that's when we're going to run into some trouble. And you think over the course of 1 to 2 years, we could see a pullback of 40 to 50% in the S&P and the NASDAQ. And when it comes to oil, you're also expecting a pullback down to the $40 level. I guess, you know, if the economy pulls back, the oil is also going to pull back. Gold and silver, you're also looking for a pullback there in the short term. And Bitcoin, that's also going to get hit. Did I summarize everything okay there? Or
I think that summarizes everything. Again, most stuff is going to pivot around what the SP 500 does, which is kind of the broad, I would say, the global kind of barometer. So if it goes into the tank and rolls over and we go into a bear market, everything gets liquidated, and it really just causes a ripple effect through most asset classes. So there is no real safety. And one of the things I should quickly mention is a lot of people, I see diversification very differently than most. So people will say, well, I own a whole bunch of sectors and a ton of stocks. I'm totally diversified. The way that I see the stock market, which is why I trade ETFs myself, is because I believe the stock market is one asset class. I don't care if you own 400 stocks. It doesn't matter. They're not, to me, that's not diversification. You have your money in one asset. When the stock market goes down, they're pretty much all going down. And so what I do is I rotate. When the stock market's not in favor, we'll move to a different asset. It could be the dollar. It could be just a treasury note ETF that pays us daily dividend. It could be bonds. So there's a big disconnect in kind of in a way that I trade money versus a lot of others. And people who own a ton of stocks and think they're fairly sheltered actually have put themselves more at risk, because each one of those individual stocks, when we go into a correction, pull back way more than the stock indexes, and it actually hurts them even more. So there's this big disconnect of people thinking a bunch of stocks is diversification. It actually amplifies your risk, and people don't realize it until it's too late, unfortunately. And that's what I try to educate people on, is protect your capital. Realize when the market goes down, it's like the ocean. When the tide goes down, all boats go down. It's the same with the stock market.
Very good point. And just to reinforce something you said earlier, the one safe place to be would be the US dollar.
Yeah.
Okay, great. Well, listen, that was a fascinating discussion. I want to thank you very much for spending time with us today. If someone would like to learn more about you and your services, where can they go?
Sure. They can go to thetechnicaltraders.com. It's 3 words. And there I cover the charts similar to what you and I do. I cover all the different asset classes every morning, share my trades that I put on. They're all ETF based trades. And most of my trades can be mimicked on the Toronto Stock Exchange. There's ETFs that track the NASDAQ and the SP 500 and things like those. So yeah, that's how they can follow me.
And you also have a YouTube channel?
I do. It's I think it's called the techtraders.com. Just type in the technical traders, will pop up there. And they can also, I also published a book last year called Asset Revesting. And you can get that at any bookstore. It talks about this strategy of rotating your money from one asset to another. So actually moving all out of the stock market when needed and going to something else. So you're only ever holding things going up in value. That is the key. That's where the really unique strategy comes out, when you step back and look at each market as its own asset, and that you don't need to be spread out across them. It's a pretty eye-opening experience when you see this asset revesting strategy at work.
Well, that was a great discussion, Chris. I want to thank you very much. And I look forward to our next discussion. We're going to have to get together again in May or June to follow up on these.
Sounds great. Thanks, James.
Thank you.